Hello, everyone. I'm here with my good friend Saket Jain and partner also, and we just want to have a little question and answer webinar about new investors, beginners, to answer a couple of questions of how we can start investing in real estate. We're not going to take a lot of time. We just want to answer basic questions about they came from you. And there you go. We can start off.
All right. Hey, Tudor, thanks for having me here, man. I think I'm looking forward to this. I think some of the conversations are basic, right? Especially for the ones who are starting up new. There's so many new terminologies and jargons. I think what we're trying to do is we're really trying to pull the curtain out and make sure we can expose everyone to the basics of investing in real estate as a passive investor, so that you can make a proper determination of whether an investment needs your attention when you're thinking about investing in it.
Absolutely, and I'm happy to juggle between the two of us so we can cover as many questions as we can.
Awesome.
In a few minutes. So one of the first questions I got from people is, what is cash flow? Why are we talking about cash flow all the time?
Yeah. So isn't that interesting question, right? That's it. I think it really begs down to some of the basics of that. Before we even look at the investing, what is cash flow in general? And then we can talk about what is it in investing terms, right? So the cash flow is you actually, Tudor, you want me to take that one?
Oh, absolutely. It's
perfect.
It's interesting because we talk about cash flow, but when you go to define this term, it's basically the net value in money between what you invest in a deal and what you can get back from that deal.
Right.
So it's it's usually talked about an annual cash flow or a monthly cash flow, or however you want to take it. It's that percentage that comes back to you from the money that you invested in a deal.
Yeah, perfect.
That can range from percentages, whatever the deal is about.
Correct. So I'll actually take it a few steps back before we come to that point, Tudor, because I wanted to ask about what is cash flow, right? So let's talk about the term cash flow itself, which takes its basis in accounting, right? So I know it's not an accounting 101, so don't worry about it. We need to use a reference point so that you can start looking at, when you look at the pro forma statements or investment, it actually starts to make sense. So what is cash flow? Cash flow is, this is a simple, as complex of an algebraic equation you'll ever make with us right now. So it's really your revenue minus your expenses minus your debt obligation, right? So what you'll always hear is my net operating income. Net operating income does not include your debt payments, right? So what we can say that the profit of a business, of a venture, of an enterprise is $5 million. That is good information. But what we want to look at it is, after we pay all our debt obligations, what is the net coming to me as cash? So to determine that from net operating income, you remove the debt obligation. So let's say the debt obligation was $6 million. Now, in that case, we have a negative cash flow of $1 million, right? So we're looking at net operating income of $5 million with a cash flow with a debt obligation of $6 million. So you divide 5 minus 6, which is 1. And I shouldn't have to ask you whether a negative cash flow is good or bad. Negative cash flow would, in this case, mean that you'll have to put $1 million from your own pocket into the business and into an enterprise. While it may be needed for a once in a while situation because things may be happening outside of your control, in general, a negative cash flowing business is not something that we want to invest in, right? Exactly. So cash flow is really, what's the cash in hand after paying everything, including the debt? Yes. That's really whatever is remaining is the cash flow.
Correct. And, for whoever is investing money in real estate, the term positive cash flow is basically a misnomer, because once we talk about cash flow, we want it to be positive, right? Yeah. We don't want to be negative.
Correct. So I think when we say invest for cash flow, we're not saying invest for negative cash flow, where it goes by default that you always want to have a positive cash flow, because if something is sucking the money out of your own accounts to sustain it, that's a negative cash flow situation. Now, we're not talking about is it good or a bad. But when Tudor and I are talking about cash flow in general sense, we're talking about positive cash flow after all your obligations, including the expenses, have been paid for.
Yes, absolutely. And that's bringing another subject of what is an asset, why we're investing in real estate, and call it an asset, because the definition of an asset is to produce cash flow, to put money in your pocket, not to take out money out of your pocket. So that's why the basic terms of you invest in an asset, which brings you money, brings you a positive cash flow.
Which is interesting, because I think if what we're looking at it is, it's interesting you're asking that question, Tudor, because I just recorded probably about a month ago an episode on my podcast where we're talking about is your house an asset or liability, right? That was the title of the podcast. And the whole podcast was about, and if the listeners want a more detailed answer, it was like a 30-minute answer. We were talking about exactly the stuff that we're talking about, right? And so I'll just take a few snippets from that podcast and kind of bring it up here, which is an example that I had used in that podcast was when you're buying a rental property, right? There's most people are saying that, oh, it's in an appreciating market, so I'm okay putting out $200, $300 from my pocket as negative, right? Or what we're trying to do is let me also overlay the tax savings and the principal reduction and all that as a cash flow. Well, I think you can go complicated financial engineering way, or you can look at very, very simplistic formula that I just gave you, which was your revenue minus your expenses minus your debt obligation, right? Everything else is gravy on the top. That's what cash flow is. And what we want to do is we call assets, and the difference between assets and liabilities is assets feed you and liabilities bleed you, right? So what we're saying here is when we say assets feeding you, as in it's throwing off cash that you can use to do whatever you want to. Now, hopefully we'll do it sensible things with the cash flow. We're not just going to go buy a Ferrari. We may, but that's not the goal, right? You may get there eventually, but the goal is to take the cash flow positive, and that asset, the cash flow, is going to feed your needs and wants and desires. Exactly. The other one is liabilities, where you're saying, I'm going to put $200 every month. Yes, it may not seem a lot, but principally, you have to understand what's an asset and liability. We're trying to invest in assets that produce positive cash flow, so that you can continue to invest more and more and more.
Yeah, that's a great answer. So that brings me to the next question I got, which is, what is the difference between an active income and a passive income? We have to understand this would address mostly professionals that are either working as a W-2 or they have some private enterprise in their business. And most people, when they invest, they want to know, is that income an active income or is considered a passive income?
Yeah, so I can give my perspective, right? In general, what is active and passive? I think you'll understand that any answer that we're going to talk about, we're going to first take it from the first principle, and then we'll take the reality into it as well, right? So if you look at active versus passive, the word active in itself entails that there is an active involvement on your side, right? And the word passive is that you are there, but you're really not needed, right? If you wanted to play a role, you could, but the activity doesn't need your involvement, as on an active day-to-day basis, right? Yes. We'll take the same exact concept in active income and passive income. Active income is if you stop coming up, like in your practice, chances are, Tudor, especially when you started out and you didn't necessarily have a team, if you don't show up, you don't serve a patient, you don't get paid, right?
Correct.
So it's really your efforts are equally translating into your ability to earn. So if you stop working, if you take a vacation, you don't make money.
Exactly. I would always associate that term active income with inactive, lack of income. So if you're not active, you don't get income. If you don't go to work and you don't pay the time, you don't get income. So it's inactive.
Correct. And the word passive, what we're saying is passive is that it doesn't need your involvement, right? Now you need to stay on top of it, Like there's nothing called as 100 passive. There's degrees of passivity involved, if that's even a word, a passiveness involved. That in some maybe 97% passive, in some you may be 80% passive, in some you may be 20% passive. Right, the degrees of involvement changes depending upon what kind of investment we're talking about. But in general, the principle is that your involvement is not needed in day-to-day activities. So if you decide to take a vacation, the business, the enterprise, the investment is going to still continue to work. And a great example is real estate, right? So
Correct. And
and real estate
the,
actually has variety of passivity involved, right? If you go buy
yes,
a rental
we're going to
unit by
cover
your
some questions about that too.
perfect. So I'll cover it at a high level, then we can go deeper. If you're buying a rental property of your own, if you have never owned one, it's a great fantasy that it's passive. But if you owned one, and I know Tudor can attest to that because I know his stories. If you have owned one, you know it's not passive, especially when things start to break, when the tenants are calling you, when you get summoned because of stupid stuff that happened. So it's not really active. But yes, it doesn't need your day-to-day 24 hours work. But it needs you to be involved. The other extreme is syndications, right? Where Tudor and I are active syndicators, we bring the deals, whereas then we and a team of our co-syndicators are running the property on an active day-to-day basis. And as a passive investor or as a limited partner, your only goal, your only active role is to making a decision. That's the only active role. So
Correct.
your active involvement is really 1%, but at the onset and after that, you're not necessarily involved. You're more than happy to be engaged, but your involvement is not necessary.
Exactly. And I'm making an association here with the passive income side of things, that wherever you have that passive income is basically making money while you sleep, right? You
Right.
don't have an
Correct.
active involvement. You just go to sleep and you know that asset is producing income. When you wake up the next morning, you're going to have
Correct.
a check in your bank.
Correct.
So that's a very good association with people that are want to invest money in real estate and realize that whenever they put in something, a little bit trickles down every day towards them, because the tenants are paying that rent, and everything that's positive cash flow is considered a passive income.
Yeah, and also I think a few other things on top of it, right? The taxes. We haven't talked about taxes.
Yeah, we'll get to it shortly.
So passive income gets taxed differently than active income.
Yes.
And
Yes.
we can sort of table that question and cover that in later. But I wanted to make sure that people understand that passive income gets taxed favorably to us, not to IRS. And
Correct.
the active income gets taxed favorably to the IRS and not in our favor, right? So that's also an important aspect to put in when you're making a decision whether you want to be active or you want to be inactive,
Yeah.
which is passive.
And that's a good passage to our next question, which is a very simple one. I have an investor who says, I have a full-time job.
Mm-hmm.
What is the best way to start? I can start creating passive income.
Well, I've been in that same situation, and I can give you a little bit of backstory. I've been in the professional life as an employee for the last 22 years, and I just quit my W-2 with Airbnb, probably about 2.5 months ago. Thank you, Tudor. Thank you. It is major. It's the one that would not have happened if I didn't intentionally ask the same question to myself.
Correct.
How can I create a passive income while I'm fully employed or while I'm fully active in my business, right? So the path I took, which I think is a path that most people are taking, I'm not the new one. I'm not being a pioneer in this field. Somebody else has done that. I just copied their model, right? It's really trying to. There's a concept that I learned. It's called, we're gonna go a little bit of physics here. So it's really momentum equals mass time velocity, right? Which is the only level of physics we'll stay. It's important for me to understand, to explain that it's a Newtonian formula, principle, that momentum equals mass time velocity. And the concept of momentum is very important. It's because a body in motion keeps in motion. It takes less force.
Let's call it Mo.
Let's call it Mo. There you go, man. Right. Right. So when you look at that, it's an important concept. Now, why am I talking about physics and when we're talking about investment? The reason I'm talking about physics is there's two aspects in momentum formula, which is mass and velocity. Now, how are we going to translate that? The mass is the investment, the amount of money that you have there along discretionary income that you can actually use to invest, right? Now, if somebody starts with a zero investable income, their path is going to be very different than somebody who's highly paid salary, and they may be able to save a lot more in cash flow. Again, the cash flow concept is coming in, right? So they have a lot more investable capital. That's where the mass comes in. The velocity comes in. How fast can your money give you returns and come back to you to invest more of it, right? So those are the two concepts. And if you understand those two concepts, you're going to look at the W-2 very differently, right? So you could be a career aspirant person. That's completely fine. And I'm not saying it's right or wrong. That's a personal decision. But we're saying is when you are so blessed and fortunate to have a high paid income, if you can generate the mass, which is you can amass the investable capital, which is in your control already. You may have to change some life decisions, but you already have that. The second aspect of that is velocity, which is also important because that's when is what investments do you invest your money in to put your money in that can give you a faster return, right?
Yes.
So a simple answer to that question is remember the concept, mass time velocities. Mass is what your high paid W-2 is going to give you today. V is the velocity, which is going to give you compounded returns on the invested capital. And when you multiply the two, you're going to be an unstoppable force.
Exactly. That's very well put. Now, let me continue on that thread and say, I'm a full-time job employee, let's say, as an investor, and I want to create passive income. Why do we advise people to invest in real estate versus other categories of assets like stock market or cryptocurrencies or bank savings account? What is about real estate that creates this like really magic cash flow?
How much time we have for that question too?
Short answer.
Yeah, so I think, look, investing is a sport, right? And any sport, you need to understand two things. You can play rough and aggressive and risk sitting outside on the bench because you got a yellow card, right? Or if you play within the rules of the game, but still play aggressively, but strategically, there's a very high likelihood you may stay in the game and you may win it, right? So the reason for that analogy is when I'm looking at investing in stocks, not a lot of people that I know of, even the smartest of the people, understand what's going to happen in the stock market.
Yeah,
because the
you
stock
have no
market,
control.
You have no control unless you're the Fidelities of the world or the Schwabs of the world, where you can move the market because of the amount of capital you have. But people like you and I, we're at the mercy of the decision that somebody else is making, who are the market movers, right? So we don't necessarily have the control.
It's more or less of a gamble, you know.
It's really a gamble, right? So now they may say there's technical analysis, there are technical indicators, and all that goes. I don't understand those, so I'm not saying they're good or bad, but in essence, if you want to go that route, it's not passive anymore because you have to be actively involved, right? Day trading, reading these charts, reading these indicators is not something you can just say, I'm going to take 2 months vacation, sit in Belize or whatever your preferred location is, and can run it while you're sitting margaritas the entire day, right? That's not a path for that. Now there's a role that stock market plays, and I agree that I still say that there may be a role. But to your key question was why go invest in real estate versus any other asset class, right?
Why is real estate so advantageous for creating passive income compared to these other options that we have? Stock market, savings accounts, cryptocurrencies.
Yeah, so I think, look, since thousands of years, you probably have heard it, like most wealth is created in real estate, right? And that's a true statement. I have seen it in my short span of life. Tudor, you've seen it as well. The others around us have seen it. So what we're saying is that real estate is an asset class that gives you income in 4 different ways, right? apart from it being less volatile, which is always true, it's less volatile than stock market, because actually this point deserves a little bit of attention, as in most people will say real estate is illiquid, right? That, which essentially means once you put your money into a real estate asset, I can't sell it tomorrow, right? Now, there are two ways to look at everything. One way to look at it is this is good or this is bad, right? And if you think about it, it's actually, from my point of view, advantageous because you're less emotional. Like most stock market decisions happen because of emotions. That I heard a tip at a party, let me go sell my Tesla. I'm just using Tesla as an example. Or let me go buy Airbnb, that because I think somebody was telling me that it's at $85 a stock price. It's valued very cheap, right? These are all opinions. These are not facts. Most people don't have any of the facts together. They just have the party lines, right? But when we look about real estate, yes, your house may be down or your apartment may be down. It's tough luck. You can't sell it tomorrow, right? Which is great because what you're trying to do,
a real estate asset doesn't go anywhere. It's there.
it doesn't go anymore.
Unless
so yeah, the market may be down today,
right?
But eventually it's going to come back up. Now we're not saying the 2004s that real estate only goes up. We're not saying that. In the long run, real estate's always up.
Yeah, I always said that you can get rich very quickly, probably with stock market or cryptocurrencies or any other form of those kind of investment, but you get really wealthy in real estate.
Yeah.
So it's a long-term game, definitely.
It's a long-term game.
Yeah, it's a game that you play consistently.
Correct.
Not giving shots of money loads in stock market or cryptos.
Correct. Like that. Correct.
So let's go a little deeper here. If you would choose real estate for those reasons, what are the few types of real estate investing that we have available for an investor?
It's actually, that's the sub-asset class within real estate is pretty broad, right? There are, and the new ones are going to evolve. So the typical bread and butter, right? Single family homes where people like you and I live, raise our families, right? So that is one type of investment. The second is the apartment buildings, where me as an immigrant, I spent a bunch of years when I came in because I had no credit history. I had nothing to set up. My only option was to go to apartments which have policies for that kind of demographic. Now, third type is, now within that, there are multiple classes of apartments. They're like people where there are classes where people like you and I will be feeling comfortable raising our family. And then there are other classes where there are drugs being dealt right outside of your house, right? So again, there's different classes within that. But beyond the apartment buildings, there's industrial, there's office, there's retail, there's parking lot, there's mobile home parks, there is
storage facility,
warehouses. I just got exposed to marina, where people are now renting boats to call them their homes. Right, that's another investment class in real estate.
What would you advise a first-time beginner investor if he wants to invest in real estate? Why multifamily? Why would you say that?
I would say as a starter, you only have two options. Now, you may have multiple options. I'm not saying that's the only two. I would recommend only two. You either go single family or you go multifamily. And the reason for that is because all of us understand these two. Because if we haven't lived there, somebody we know, either our parents or our friends or somebody, they either live there or they have owned one, right? So that's really why I want to start there. I'm not saying other classes are bad. Other real estate sub-asset classes are bad or good. It's just that you understand this better, right? Now the comparison is left between whether I should go single family or whether I should go multifamily, right? And the reason for me to pick multifamily is multiple varieties, right? So if I'm buying, Tudor and I, we only deal with apartments that are 100 plus units, right? We don't necessarily deal with 20 unit apartments. Now that is also an asset class that you can look into. So the comparison now happens, I'm sort of narrowing your question down, Tudor, is should I buy 100 single family rentals versus should I invest in a 100 unit apartment? Exactly. So now that's a simple question left, right?
Yes.
So
let's say you have $100,000 to put in.
Right.
Would you buy a single family home with $100,000 down and get a loan for another 400, so a 500,000 value, one house, or would you put $100,000 to buy 100 units, multifamily apartment building? What would you do at this point?
If I, knowing what I know now, if you asked me that question 5 years ago, it would be a very different answer because I didn't know anything better. If you ask me now, my answer would be you want to invest in, you want to put that money into multifamily asset class. And really, here's the reason why. Let's say we're talking about a 100-unit apartment building, right? That 100K goes towards that. So one is that when I buy a single family unit, if one of that unit is vacant, my vacancy for the entire portfolio is 100%.
Correct.
Right? And on an average, a multifamily is closer to 8 to 10%. So if you look at that, 90 to 95, 90-ish percentage of the time is going to be occupied, right? Fully.
Yeah.
So that's really what we're looking at now as one example of the vacancy itself drops, right? The second one question. Second is, I could be actively involved in creating another $100,000 that I can have investable capital because now I can focus on what I do good, which is my W-2. I don't have to learn how to run an apartment building. Right?
Yeah.
The third is going to be your single family is a recourse loan and your multifamily is a non-recourse loan. What that essentially means is if you were to default on a property as a single family, they'll come back to all your assets that you have to recoup the money that the bank provided. But in the multifamily, the bank is giving you the loan against the property, not against your own assets, right? So they'll take away that asset. Now, which is actually a very important point because what you're now doing is the bank won't give you the loan if the bank doesn't think it's not going to perform. So, right. So you already have one additional level of due diligence by the banks who, of course, have been doing it for a while rather than just a limited partner who may just jump into a deal tomorrow, right? So you'll have to learn that thing. So that's another. It's
funny you say that because I always thought, I was thinking and read about this. If you go to Bank of America to get a loan for a multifamily apartment building, and you put the down payment, and they'll give you the loan based on the 100-unit apartment building because it's an asset for them too.
Yeah.
That same bank would not lend you money to go on the stock market and buy the Bank of America stock.
No,
their own stock.
Their own stock. They won't. They will not. You're right. You're 100% right, my friend.
So there you go. I mean, this is the classic example of comparison between the two investments. But yeah, go ahead. I think.
I mean, we can tell. There's so many benefits. Like one important benefit is how it's valued. That's an important one. That's probably a different episode altogether. Yeah. But to give you a high level, your single family rental house, regardless of where you are, you'll only get the price what the next door house is selling for in the neighborhood, right? But an apartment complex, you're really valuing that as a business. So it's a multiple that gets applied on net operating income, which is essentially, as we go back to the previous questions, is your income minus expenses, right? So everything gets determined by net operating income. So if you have an house, apartment building, and I have an apartment building, and your apartment building is producing $10,000 in net operating income, and my apartment building is producing $1 million in net operating income, even though the apartments may be identical, mine is going to go at much higher value than to yours in that example, right?